What is a home mortgage? A home mortgage is a loan given by a bank, mortgage company, or other financial institution for the purchase of a residence, a primary residence, a secondary residence, or an investment residence, in contrast to a piece of commercial or industrial property. In a home mortgage, the owner of the property transfers the title to the lender on the condition that the title will be transferred back to the owner once the final loan payment has been made and other terms of the mortgage have been met. Should you buy a home with cash or a mortgage? A home mortgage is one of the most common form of debt, and it is also one of the most recommended because they are secure debt and as that act as backing for the loan. Mortgage come with lower interest rate than almost any other kind of loan that an individual consumer can find. How a home mortgage works? Home mortgage allow a much broader group of citizens the chance to own real estate, as the entire purchase price of the house doesn't have to be provided upfront, but because the lender actually holds the title for as long as the mortgage is in effect, it has the right to foreclose on the home if the borrower cannot make the payment. A home mortgage will have either a fixed or floating interest rate, which is paid monthly along with the contribution to the principal loan amount. In a fixed rate mortgage, the interest rate and the periodic payment are generally the same each period. In adjustable rate home mortgage, the interest rate and periodic payment vary. Interest rate on adjustable rate home mortgage are generally lower than fixed rate home mortgage because the borrower bears the risk of an increase in interest rate. Either way, the mortgage works the same way. As the homeowner pays down the principal over time, the interest is calculated on a smaller base so that future mortgage payments apply more toward principal reduction than just paying the interest charge. In a mortgage transaction, the lender is known as the mortgagee and the borrower is known as the mortgagor. Type of mortgage. There are different of mortgage loan that the borrower may use to purchase a home. Generally speaking, they can be grouped into three broad categories: conventional loan, federal home administration loan, and specialty loan. Conventional loan. Conventional mortgage loans are not part of a specific government loan program. This loan can be conforming, meaning that they adhere to mortgage rules set by Fannie Mae and Freddie Mac, or non-conforming. Private mortgage insurance may be required for conventional loan when the borrower put less than 20% down. FHA loan. FHA loans are mortgage loans issued by private lenders and backed by the federal government. Key characteristics of FHA loan includes lower credit score requirement and lower down payment requirement. It's possible to get approved for an FHA loan with a credit score as low as 580 and a down payment of 3.5%, or a credit score as low as 500 and a 10% down payment. Specialty loan. Specialty mortgage loans are loans that don't fit into the conventional or FHA loan categories. These include U.S. Department of Veteran Affairs loans, which are designed for veterans and their families, and U.S. Department of Agriculture loan, which allows borrowers in eligible rural areas to purchase homes with no down payment. The VA loan program and USDA loan program don't specify minimum credit score requirement, but generally, lenders look for score of 620 or higher. What is included in a mortgage payment? A typical mortgage payment can include four costs. Principal. The principal is the amount that you borrow and have to repay to your lender. Interest. The interest is the main cost that you pay to the lender for borrowing money to buy the home. Mortgage insurance. Mortgage insurance is designed to protect the lender if the event that you default on the loan. Whether you pay this or not can depend on the type of loan and the size of your down payment. Property taxes and homeowners insurance. Lenders often roll your property tax payment and homeowners insurance into your mortgage payment. Part of your monthly payment is redirected to an escrow account to pay this expense. These costs are spared from upfront fees that you may have to pay to purchase a home. These include your earnest money, down payment, appraisal and inspection fees, prepaid fees, and closing costs. Thank you.